You have managed to put some precious cash aside for investment after you have paid all your short-term debt like credit cards. Well done! Now you realize that you have no idea where to put that money to work. You might first want to understand what are the assets that are of interest to you and where you could invest that money. You can check that in this video here and here. Assuming you're interested in the stock market, in investing in stocks, what are the best world stock markets where you can expect the best returns on your investment? In this video, we will look at the best metrics to uncover the best places in the world to invest your money and mine. Let's go on a world tour. My name is Greg Angelbert. I'm a life and personal finance coach. I share what I know about coaching and personal finance on a cup of coffee to help you live a life of purpose and build up your wealth. One way we can look at the best stock markets in the world is to look at which are the biggest ones. If people put their money there, there might well be a good reason for this. That links to the momentum theory of investment, which means that when money flows in one direction, in one place, in one sector, in one stock market, it tends to do so for a while until it reverses. So follow the money. According to the latest data, the largest stock market in the world is the New York Stock Exchange in the US, which is basically about $26 trillion in market capitalization. And the second one is also in the US, it's the Nasdaq, with close to $17 trillion in market capitalization of companies listed there. Overall in the world, the US represents 54% of the total market capitalization of all stock exchanges, a behemoth. You can see the list of the top 20 out of roughly 2020. Some names appeared quite recently, like China, India, Saudi Arabia. Interestingly, the world stock market capitalization in 1975, the year I was born, was just about $1.1 trillion. By my 18th birthday in 1993, this market capitalization had moved to $13.9 trillion. And as of December 2022, this total world market capitalization is worth $113.1 trillion. That is a 10,000% growth over the period, which is about 48 years. And otherwise you can say it's about 10.1% per year. If you could have invested in all the world stock markets, like one just big box of stock market, since 1975 you would have had quite a good return. Inflation is part of that, but that would still be a very decent return. Today you're actually able to do this. There are ETFs, exchange traded funds, which reproduce the vision of the total world stock market. They invest in a little bit of everything. And that you can find on a variety of websites that I've put in the description. And you can find a picture of the top ETFs for world stock market right now. The world stock market looks good when we're considering the return we can get from it. But can you get better return if you're talking about country-specific performance? For that, we can look at the best stock market performance from 1900 until 2019. What we see here is that Australia tops the ranks with 9.8% annualized return. This is based on US dollars. The problem with this view is that many different types of events have happened during such a long period of time, and it's not really representative of our lifespan. It also does not take into account the trajectories of the different countries in terms of economic performance. This is visible in this graph for the Australian stock market. You can see major drawdowns in 1929, World War II, the Cyclone Tracy, and you also have major upswings which are also visible. If we look at a shorter time frame, like the past 10 years, we get a very different picture, with the US coming first, Taiwan coming second, and Netherlands coming in third. And we still have another problem, which is that we don't know really if any of those stock markets are expensive right now compared to their long-term average. And past growth is not a guarantee of future growth. Are you enjoying the stock market world tour? If you are, then you know what to do, and also do not forget to subscribe, put the notifications on if you want to receive content like this every week. Also check out other videos from other YouTubers in the description talking about the same topic about the world stock market. You might find some interesting information there. Another way to check the stock market performance in different countries is to look at the PE ratio in a specific country. The PE ratio is a price-earnings ratio. For a country, it is basically the average price per share of all the stocks listed on the stock exchange divided by the total earnings of those companies. This is typically done for the past 12 months, but it can also be done for the next 12 months, which is also called a forward PE. And the way it looks like is a multiple, like 10x, 20x, 30x, 40x. The problem with that is that 1 year does not tell us much. Another ratio which was proposed by Robert Shiller of Yale is called the CAPE ratio, also the Shiller ratio. CAPE stands for Cyclically Adjusted Price Earnings Ratio. The difference here is that it looks at the past 10 years of earnings and compares it to the current price of the stock. It is also adjusted for inflation to normalize the earnings. The CAPE ratio is very useful when you're trying to understand if a market is overvalued or undervalued. It's also a pretty good trend indicator for the next 10 years, let's say. So good for entry and exit points in the market. This picture shows you the primary stock markets of the world and how their CAPE ratio has evolved. That is quite a messy picture. It tells you that the ratio can vary wildly. The very large multiples that you can see here are from Japan, for example. To make it simpler, I have grouped the markets which are currently with high CAPE ratios. Here we find Australia, the US, Canada, the Netherlands, India, Switzerland, Taiwan, France and Japan. And in this picture we have the markets most undervalued compared to their average. Those countries are Korea, Brazil, Hong Kong, Spain, China, Poland, Israel, Singapore and Turkey. One important aspect is that each country's CAPE should be compared with its long-term trend. This is because some countries command higher CAPE ratios than others over a long period of time. This picture shows what was the difference between actual CAPE ratios at the end of 2021 versus the long-term average. The problem with trends is that they can be misleading. Countries are on economic trajectories which might bring different CAPE ratios over time. And the different industries, the sectors of the economy can have a very different impact on the CAPE ratio of a country. Like tech, having higher multiples than consumer staples, for example. It is also important to consider the impact of interest rates on the CAPE ratio. For instance, fixed income type of investment has been very low due to low interest rates over the past 20 years, which means that more money has flown to equity, increasing the average CAPE ratio. The case in point is China. Early speculation after the opening of the first fully accessible stock exchange brought the CAPE ratio from about 11 at the beginning to 55. And now we're back to 11. But what is the right long-term CAPE ratio for China? It very much depends on how much the Chinese people will believe in the stock market again, their confidence, and whether or not they will progressively come back into the market and other investors from across the world come back in the Chinese market. But if the confidence is not there, whether inside China or outside China, it might get stuck between 10 and 15. This picture shows you the average percentage of the population who invests in the stock market in different countries. What would be the impact of India and China just having double the current percentage they have on their respective stock market valuations? Now let's get to finding a way to actually invest in those markets. The best way by far to invest in country stock market or the world stock market is to use ETFs, as we've mentioned before. There are three key elements to consider when you're picking them. The first one is the total expense ratio that you are going to pay every year. Ideally, you want this to be lower than 0.5%, but it depends on how exotic the country is for the ETF. A US stock market ETF can go down to 0.03% TER. If you take one from Turkey, that will cost you 0.57% per year. If you stick to the big names like Vanguard, iShares, SPDR, you will not have that problem. Mirror ETFs have hidden fees coming from what they are mirroring. The third aspect is whether the ETF is distributing or accumulating. That means that the dividends are whether paid out to you or they are reinvested in the ETF. That's pretty much up to you what you desire. The websites mentioned in the description are very good at explaining all the different types of ETFs that there is worldwide, sector-wise, countries, etc., etc. And the best way to buy ETFs is to use brokerage account. There are many of them, and I use Interactive Broker to buy ETFs or stocks or any type of securities. I like Interactive Brokers because, well, they're fairly cheap. The fees are pretty low in terms of transaction fees. They also, I think, have the broadest range in terms of the market that you can invest in. So if you prefer to have just the US or more limited market, you have TD Ameritrade or other companies like that. If you're interested in Interactive Brokers, you can check a link in the description. It's actually an affiliate link where you can receive $1,000 of Interactive Broker stock if you sign up through that link. Any freebie is good. So this is not an exercise in stock picking. This was more to look at what are the different angles that you can look at when you want to actually get the best markets in the world in terms of good returns. And the ETF approach is the most accessible approach for investing fast and very low amounts to very large amounts. What is my conclusion in terms of what are the best markets out there? Well, I like the CAPE ratio. I think it's good. I think mixed up with a growth aspect, looking at the countries which are most likely to be growing in the future And I'm thinking about, China, India, but also some of the countries with low CAPE ratio compared to the past and who have good growth prospects. One key aspect before you go into investing is to actually know what do you want out of your investment on one side, and also what type of investor are you. Investing is, after all, a very personal decision, and it's important you understand yourself, you understand your goals before you go on and invest. If you want to learn more about what type of investor you are and how you can take those decisions about investing based on who you are, check this video here and here. You might find that useful. And I look forward to seeing you next week for more personal finance and coaching on a cup of coffee.